Commodities have not been doing badly. Oil holding above $80 a barrel over the past week. And remember, it has struggled. Previously, it struggled to do that for several months. We've seen copper going to multi-month highs and gold not far off records. There's the Bloomberg Commodity Index. So it's still down 3% in the past year, sure, but it has been bouncing off the bottom lately. Our guest says these rallies in commodities are sustainable. We're joined by David Swinburne, Managing Director and Global Head of Commodities at TD Bank. David, thanks very much for coming on the show.
Nice to be with you, Andy.
I know it's a bit meaningless to talk about commodities in general because they're so different, but there does seem to be upward movement here. What's the main factor?
Well, you've picked three good ones, oil, gold, and copper. Both, I think, are setting up well here. Oil and copper, in particular, for the supply constraints that they're dealing with. One, a manufactured one in the OPEC cuts with oil, but copper, from the lack of investment over the past years and some disruptions in supply, it's setting up, we believe it's in a deficit now and setting up for higher prices. Gold, we don't think is particularly too leveraged to the long side. And all of this with a backdrop of a Fed that is providing a put, whether they know it or not, in terms of the next movement being a price cut. And what we're seeing across all asset prices is movement of cash off of the sidelines into asset classes. And in particular, hard assets like commodities look to be a good place to put money.
And we're hearing reports that hundreds of thousands of daily barrels of oil a day in Russian capacity is being taken offline by these Ukrainian drone attacks. So it's yet another geopolitical factor tending to push oil higher.
For sure. And juxtaposed to that as well, you have China demand picking up. And I'm not sure the Fed is expecting a surge in crude prices here. I'm not saying that is our base case, but if we see a 10 to 20% rise in crude prices, the impact on inflation is certainly going to start to pivot some of the what we're hearing from the Fed, which should have an impact on global, across other markets.
Oh, that's interesting. So it could, in theory, tend to stay the Fed's hand, delay interest rates cuts?
That's what I think is the risk here that isn't being priced in. I think the amount of cash moving from the sidelines across asset classes, potentially into oil, could have that influence over time.
What about copper? I mean, the world got a shock, didn't it? The mining industry got a shock with the shutdown of Cobre Panama.
Yes, copper is set up from an S&D model perspective quite well here. And if demand in China picks up in any way from here, we should see a sustained rally in copper.
Talk to us about gold. Gold is always a bit of a head scratcher for me because when inflation comes down, rates come down, and that helps gold. But it's supposed to be an inflation hedge. But of course, the markets are always trying to double guess themselves.
Yeah, gold is the ultimate inflation hedge. I think that hedge, though, has been diversified with other products over time, whether it was crude oil or Bitcoin now, or equities. The movement away from the dollar into other asset classes, I think gold is sharing that a lot more these days with other asset classes, but still a viable one to hedge against inflation.
What do you think Bitcoin, let's put up Bitcoin because it has come off its highs, but do you think Bitcoin has to some extent stolen market share from gold as a hedge?
I think gold investors are sticky and particular about gold. I wouldn't say that the overlap is too large there. Nevertheless, it can't be ignored. It's a significant market. It's a market disruptor, and I believe it's here to stay. So I do think it will take market share over time. Certainly, as the younger generations, I think, are adopting Bitcoin more and more. But I think gold always has its time to shine.
Yeah, it is fascinating that gold. I'm trying to think. Gold has those tailwinds, and also I'm not sure if you mentioned the central banks, but that's part of the move out of the U.S. dollar, or some investors shying away from the U.S. dollar. China and Russia building up their gold reserves.
For sure, the diversification away from the U.S. dollar has been a theme for some time now, and I don't see that pivoting. Certainly, if the Fed becomes accommodative again.
Do you think the market, I know that we're straying into economics here, but do you think concerns over America's spiraling upward government debt is a factor too?
For sure. The debt levels are unsustainable, and we're in an election year, so all the talking points and agendas are going to be pivoting to, if anything, a more accommodative stance. You also have potential tariffs coming with the election of Trump if he gets elected, which again might have inflationary impacts and force the Fed into an uncomfortable situation.
We've less than a minute, David. Is there a price at which WTI oil would get toppy where you would be inclined to lighten up on positions?
Yeah, I mean, right now I think we're in the top of the short-term range, but I think it goes higher. I would say maybe another 10 to 15% higher would be a good level to hedge or take some positions off.
And what about copper? Copper around $4.13 a pound today. What price would you say? Where would you see a ceiling for now on copper?
Copper's an interesting one. Less deep of a market. I think the institutional investor is not completely in that market yet. So I would think probably 20 to 25%.